Hello and welcome to Author's Note with me, James Mackintosh. Today I'm going to be talking to Ewen Cameron Watt, Chief Investment Strategist at the BlackRock Investment Institute, about metals and mining. It's been a very important sector for the last few years, produced some stunning returns thanks to the outrageous demand from China. That's fallen off a lot recently and the sector's done very badly this year, down about 4% so far, while the stock market worldwide is up about 8%. Ewen, you're rather more positive than that, but before we come into talking about whether this is a buying opportunity or perhaps more of bad news to come, just go over to the first chart we've got here, which shows the performance of global miners against the stock market since 1973. It's on a log scale, so actually the gap between the two is far bigger than it looks, but the blue line there's the world market, the red line shows the miners, periods of very strong outperformance, and obviously very strong underperformance over there, but more recently a mixture of both, but they remain very strongly up.
I think what happened, James, about a decade ago was there was a lot of structural consolidation in the mining industry. I put it simply that financial sense overtook mining sense. You know, miners always want to dig more out of the ground. And looking at this chart, it shows the US recession. That was true then, but of course now it's the Chinese cycle with over 50% of a number of metals going into China.
This is all about demand from China.
I think at the margin, materially so, just given the absolute tonnages. And China, people talked a lot about China is slowing down. Well, yes, the growth rate is slower, but it is a growth rate. And the absolute tonnages that China will take in terms of increasing over the next several years will, I think, deal with most of the worst of the supply in a number of key metals.
But of course the price comes down to the supply and the demand. You're saying you think the demand will hold up and increase a bit, if not at the same rate as before. But typically what has happened in all these previous, here we're only going back over one super cycle and a bit, but still in all of these little cycles what's happened is that miners have overinvested in the good times and then prices have stayed very low in the bad times. If we come over to the next chart, we can see in fact some data you provided, but the total amounts of capex, and obviously expected to hit a new record this year.
But I think it's what's happening in the shares inside that, the shares of the capex inside that, James. I mean, exploration has risen a bit in recent years, and I think that's partly been because of the bull market in the shares has allowed a lot of marginal companies to get involved. I would expect that to decline quite a lot in the next few years because of financing pressure. You can also say that the cost of being in it has gone up because of an acceleration in prices of a lot of the capital equipment. But most of it, the green bit, growing the business, that's coming down, and it's mostly about sustaining mines that are getting older. I mean, the last big copper discovery was 1981. After all.
Yeah, okay. But is that an argument for thinking that the shares should be good value? I mean, to paraphrase, your argument is a lot of this capex is that they're having to spend a lot more to do much the same as they used to do, which should suggest they're going to be less profitable than in the past.
Well, the new buzz phrases you hear when you talk to the mining companies are world-class, low-cost, and sustain. Now, I think that those are all very fair things. I suspect that we're going to see the large benefiting relative to the small, apart from anything else, because of financing availability.
So they really do have financial discipline this time?
I think so, yes, very much so. I mean, the point about the capital expenditure and the cycle is that it takes a long time to bring a mine on. You could well be spending the end of that as the cycle has turned against you just because of lead times.
Yeah, okay. And I mean, I've heard this in lots of different industries over the past couple of decades, but you really believe that this time they get it? Because they would always have said they had financial discipline.
I think it comes down to individual companies, it comes down to individual mining projects. Resource nationalism, which we haven't talked about, is cutting supply out. The problems in South Africa with the gold mining companies and labour costs generally are very well known. So I'm not going to give it a blanket pass, but I think there's a lot of companies that are doing better than others, and the performance this year has been very dispersed in terms of individual names.
Okay. So which metals?
Copper, grades going down by 5% per annum. You've got to dig up 5% more rock every year for the same amount. You can't substitute it. Aluminium over the cycle, And zinc, I think, with the pickup in car demand in the United States and car demand recovering in China. And China is still growing, and the economic momentum there, as we talk, seems to be picking up a little bit.
Okay, well, fingers crossed. Thank you very much, Ewen.
Thanks, James.